Hello, thank you for joining Minds of Commercial Real Estate. Today we have Lee Kleinman from BFC again. Lee, thank you for being on the show again.
Thank you for the invitation. I think it's my third time here, and I always look forward to spending time with you, Camiar.
Yeah, I appreciate it.
You got what I want, got what I want. You give me just one look and you know I'm good to go. You know I'm good to go.
How have we been?
Doing good. The industry seems to be continuing to be steady, so we're happy about that, which means we get to help more small business owners that need our valuable lending services and products. So
amazing. That's
good out there. Yeah,
then that's a majority of the deals being done.
correct.
So the SBA implemented a couple new credit policies, and SBA meaning the Small Business Administration, and just want to review those.
Sure.
First one being the citizenship.
Yes, effective March 1st of this year, there's a new citizenship requirement that's very different from the past in the fact that 100% of the business entity ownership and the real estate entity ownership all must be now U.S. citizens or U.S. nationals, and there's no policy exceptions to that. So since that went into play a few months ago, I've had to turn down a few borrowers that don't meet that requirement. And hopefully they have enough capital to go conventional, or they can buy a property with a seller carryback. Those are other options that people have in the marketplace.
Sure.
But for those folks that don't meet the new citizenship requirement, unfortunately are no longer eligible for SBA financing.
Makes sense. In regards to personal liquidity.
Yeah, so that's a topic that's been in place, got eliminated, now it's back in place. And that just means that the SBA is looking at the personal balance sheet and possibly the business balance sheet as well to see if there is what's called excess liquidity. And if there is, the SBA's mentality is that there's enough liquidity to go conventional and not utilize SBA resources when they're not needed. Because typically people utilize the SBA program for that low 10% down payment. So there's no specific dollar amount or how much liquidity one can have compared to project size. It's not defined in the SBA SOP, which stands for Standard Operating Procedure, which is just another way of saying that's the SBA's credit policy manual. But I would say that if the post-closing liquidity exceeds 1 or 1.5 times the project cost, then us as the CDC should be digging into, are those funds earmarked for something? Is there an open escrow where a lot of them are going to be going into and that liquidity is going to be reduced? Are they needed for retirement funds? Are they needed for college education for the children and stuff like that? So we have to look at the upfront financials more closely regarding this, specifically the PFS, which is a personal financial statement, and specifically the business balance sheet, and just look at the overall cash position of the individuals and the business entities that are guaranteeing the loan to see if we feel if it will meet SBA criteria or not. So it's something that's back, and we're looking at it to make sure we submit eligible packages to the SBA Loan Center.
Okay, makes thorough sense. And finally, regarding the 10 million aggregate.
Yeah, so historically, and I guess historically prior to July 4th, because this new policy just went into place a couple weeks ago, you were limited to a total of $5 million of aggregated debt between both government programs, 7A and 504. Mm-hmm. But now that aggregate limit has been increased to $10 million, which adds a lot of value to the small business owner because now they can borrow more money for their real estate and working capital needs. Now, if that $10 million cap is met through 7A 504 debt combination aggregated, there's still more borrowing power on the 504 program because they have the energy program that you and I have utilized once or twice before.
Sure.
We talked about it in greater detail on our last podcast together. By going energy reduction program, we're using the energy reduction program if we can reduce energy consumption at the project property, they're entitled to another $5.5 million second mortgage borrowing tranche. And you can use that green energy reduction program 3 times. So if your first $5 million energy tranche is used, you have 3 more of those energy tranches. So you could have over $20 million of SBA 504 debt. I've been doing this for decades. You've been around a long time. I've yet to see a small business owner utilize that much of second mortgage debt. So I can't say there's unlimited borrowing power, but there kind of is, because for obvious reasons.
We've never seen it fulfilled to the max.
Correct.
Interesting.
I think if a company were to blow through that 20 million plus of second mortgage debt, they must be middle market size, and probably net income is too high. They would blow through other size standards that we have to determine eligibility. So,
Makes sense.
yeah.
For current and any, there's a lot of SBA refinancing that's going to be needed in either being the 7A or either being the 504 after the first 10 years of the prepayment penalty with declining. So as of today, what are we using these SBA refinances for?
Yeah. So I don't think enough people know about the 504 refinance capabilities. And I utilize them very frequently. It's a very robust platform that really came to life during COVID with the CARES Act 1 and 2. They opened up the ability for SBA debt to refinance SBA debt. And that was literally unheard of, unprecedented. So now I'm able to use the SBA 504 program to refinance 7A debt, 504 debt, and all the other debt that was eligible before, whether it be a seller carryback or a conventional loan or what have you. And the other thing that's interesting is that you can perform a refinance with cash out for what's called EBE, or eligible business expenses. So EBE would be your typical income statement expenses, payroll, marketing, advertising, inventory, rent. And so now the government is allowing the small business concern to refi their owner-occupied property, pull cash out up to 90% LTV. So you still get that same high LTV, whereas before that cash out was limited to 85, but recently that got increased to 90 to give the borrowers more borrowing power. And in the past, the amount of cash out could not exceed more than 20% of the appraised value. But I believe that's gone away as well. So now it's a very flexible, robust refinance program. So that's one example. Right. Another value add of that refinance platform is that we can perform a refi under what's called the Refinance with Expansion program. And that allows you to refinance existing debt and pull equity out to remodel, improve, or expand the current property. And you can also take cash out from property A to buy property B. And I recently performed one of those. It was one 504 loan structure, and the client was okay having both properties encumbered. And we were able to take cash out from property A to buy property B under the Refi with Expansion program. So there's actually a lot of bells and whistles with that refinance platform that a lot of people don't know about. So I'm glad you brought that up.
Right. That's a very interesting one. We can always speak further on that.
Yeah.
That will help maybe a lot of the small business owner be able to expand if they don't have necessarily down payment and or expansion.
Correct.
Let's get into a little bit of the topic of like the special purposes properties you can buy with SBA, which I don't think many viewers really know about. One being car washes. Second would be gas stations. Third being hotels. And finally, the one we're going to speak about thirdly is self-storage, but there are other ones as well. But those are the 4 main ones.
Those are the 4 most common special purpose properties that we see. I was a business banker lender at a money center bank prior to joining the CDC. And in that bank's business banking credit policy manual, special purpose property financing on a conventional basis was limited to 50%. I don't know too many small business owners that want to cough up a 50% down payment to buy a special purpose property for their business. It's very expensive. It takes away from their personal liquidity. It takes away from their business working capital, or might not be affordable at all.
Correct.
With SBA 504, we're able to finance these special purpose properties that you just mentioned, amongst others, up to 85% LTV. So it's just an extra 5% down to get into these types of special purpose properties. And the reason why special purpose is kind of a dirty word in the lending space is because good loans go bad every day. So before a lender makes a loan, they're looking at what's the bad day here? Like how do we get out of this loan? And if we have to foreclose on a special purpose property, there's a limited buying audience for that asset. Mm-hmm. So there's a million types of businesses that can go into an office building, but there's only one type of business that can occupy a gas station. So it could sit on the books for a long time, and lenders aren't in the real estate business, so they want to be able to sell it quickly. And the less debt load on an asset like that, the faster it'll sell. But the good news is that I can finance, well, the SBA 504 program can finance special purpose assets up to 85% LTV, which is
a huge
value.
difference.
It's very big.
Now, can you also use that same program you mentioned before for expansion, where if somebody has an existing gas station, lower leverage, they want to cash out and buy another gas station?
Yes, you can still perform a cash out refi on a special purpose property. Yes.
So that's to expand their portfolios and add others.
Correct. Okay. So it comes into play, and we actually do a lot of these types of projects.
Okay.
I did a ground up construction project for a gas station in Bakersfield earlier this year.
Right.
That's being built right now, 85% LTV.
That's land and construction.
Correct. I think they own the land already, and now we're financing the construction. And they were experienced operators that had gas stations in the area, so it was considered an expansion of their existing business, and we were able to do that transaction at 85% LTV, where a conventional loan would have been 50.
Correct.
And that could have made the deal impossible.
A lot more sweat coming out from the developer.
Yeah, too much sweat equity.
Right. Makes sense.
We kind of saved the day because we were really their only option. It was a large project where it exceeded the 7A size standards, stuff like that. So
amazing.
Yeah.
That's good to know, to expand portfolio and let the viewers know there are many SBA opportunities and lending out there which you might not be aware of.
Correct.
Which you should inquire about.
So that's why I love doing something like this, because there's nuances not nuances, but there's attributes to the program that people might not know about.
Correct.
So many times when I'm speaking to clients and they'll say, oh, I didn't know you can do that. Or if I'm speaking to someone like yourself or a commercial real estate broker, and I'm talking about highlights of the program, many times these highlights are new.
Right.
And they're interested in learning more about it. And so it's our job to do what we're doing and educate the public. And the more you know, the more you can grow.
Correct. And the more you'll learn.
Correct. They say knowledge is power.
Right.
SBA 504 knowledge is firepower.
There's bigger audience for it.
Correct.
In terms of for somebody who's never done a SBA loan, trying to prep themselves to get an SBA loan, either being a 70 or 504, what are your recommendations?
Many clients come across a financing need and they're not books and records ready, is what I should say. It might be August and they don't have a year-to-date interim financial statement prepared, because some clients, believe it or not, they just rely on their accountant to perform an annual tax return. So if someone's been in business for a long time and they haven't borrowed a lot, or they don't have a lot of borrowing needs, that could change on a dime. They might have been wanting to buy the building they've been renting, but the seller hasn't wanted to sell. And then all of a sudden the seller wants to sell for whatever reason. And you want to make an offer and tie it up quick and close in 60 days, but your books and records are not lender ready. So I would say, even if historically you haven't had to borrow funds on a regular basis, keep your interim up to date on a quarterly basis, at least. And it's prudent to do because an operator should know how their business is performing throughout the year. So that's a value-added reason in itself. But more importantly, for lending and to pull the trigger quickly on something that you might have to close quick, you don't want to be scrambling and waiting weeks or months to get certain items prepared by your bookkeepers or by your accountants, what have you. So that's number one. Number two is, I know there's value in filing tax returns late or on extension, but many times lenders require the most recent year-end numbers memorialized on a tax return so they can approve the request, because somebody might only have 1 year of cash flow. Let's say 2025, they qualify, but the prior years they don't. But if that 2025 return is on extension, then that's going to delay the transaction that has to be financed. So business owners have to walk a fine line. There might be benefits or value in having that extension, but it could come back to hurt you or haunt you if a quick lending need arises. So if you don't have to have your returns on extension, they should be filed fairly quickly so you're more lender ready to finance that transaction that might have to get done quickly.
And then borrowers that qualify off the last 2 of 3 years tax returns versus 1 of 3 years tax returns can get better pricing as well.
Yeah, there are some first mortgage lenders that require 2 years of cash flow, or might offer a better rate and fee structure if there are 2 years of cash flow. Correct. SBA doesn't have that requirement, but some of the 50% bank first mortgage lenders actually do. So that's a very good point.
Right. It's at their discretion.
Yeah. So you could have someone that qualifies based on their 24 tax return numbers.
Right.
And 25 is good, but it's not filed.
Correct.
That lender doesn't have the 2 years of cash flow that they want to see to get a better pricing.
So they have the option to decline it, and you would have to go to another lender with not as
they could, if a bank requires 2 years of cash flow,
correct.
It's up to them if they want to put weight on the interim for 25.
Sure.
Most don't. So that's when you might have to bring in a different first mortgage lender.
Right.
So the banks that offer the best rates and fees, you might not qualify for because you don't have your tax returns filed on a timely basis.
Correct. Now let's hit on a very sensitive point where during COVID and afterwards, many businesses, either they owned a building, did not own a building, received idle loans.
Yes.
And during the first up to 2 years, you didn't need to make payments. After that, you need to start making payments. Many people maybe apply for hardships, missed payments, or are up to date on their payments. How does that affect applying for an SBA 504 loan?
Very good question. So any lender, a bank or SBA, before they grant additional credit to their existing customer, their existing facilities with that institution or the government should be current, up to date, and all good. So before we submit a file to the SBA Loan Center in Sacramento, our system interfaces with theirs, and we have to do what's called a compliance check. And many times we'll get an error code from the SBA Loan Center because the client has an issue with their EIDL loan. Now, that could be for a number of different reasons. There's a number of different codes, and every reason has its own code. The two most common that I see is on some of these idle loans, the government wants to collect annual financials, or they requested some documents because they were auditing the file, and those were not provided in a timely manner. So that's going to trigger a compliance code. It doesn't stop us from underwriting, but it stops us from submitting the complete file to the loan center to get a lending decision, which is needed to keep the bus moving forward.
Right.
And then the other situation I see is that people are just behind and delinquent on those loans. So those are the two main issues that I see. So if a borrower took advantage of that program that added a lot of value during the COVID fiasco, make sure that you're paying attention to what they're asking for, any updated information, but more importantly, make sure your payments are current. So we as 504 lenders don't have hiccups or delays. And you and I have been involved in a handful of projects. There's a lot of back and forth with me sharing what the issues are, you going to the client going to the SBA Idle Loan Center to get to the bottom of it. We have a deal that's in escrow now where we can't submit because there's issues with the idle loan.
Correct.
And, obviously had those issues not been in place, we would have
Been approved and funded by now.
probably for sure approved, maybe funded by now.
Right.
But I know your client's working through that process, but you brought up a very good point that these loans that were issued years ago can come back and haunt you now if they're not properly maintained and paid. So,
and one final topic I'd like to just kind of briefly review is you are able to get an SBA 544 loan on equipment,
yes.
which are, if you can hit on that subject just a little bit, please.
Sure. So the program is designed to finance real estate assets and heavy fixed asset type of machinery and equipment. And I've done several equipment loans, and it really adds a lot of value to the small business owner from a cash flow standpoint. Coming from a bank, remembering back to our conventional equipment loan product offerings, 3, 5, 7-year terms,
Sometimes 10.
sometimes 10, rarely, but sometimes. So, maybe some other lenders were doing 10, but
Sure.
not more than 10, I don't think.
Never.
At least I haven't seen it. Believe it or not, if the remaining economic life of the equipment asset that's being purchased is 25 years or longer, we can offer a 25-year equipment loan. And that adds a lot of value in the following. If a manufacturer needs more space and they're going from renting to buying, which usually has a higher monthly payment than rent, so their expenses are already increasing. There's benefits to offset that with the write-offs and cost seg and all that stuff. But generally speaking, from day one, there's more expense on their facility requirement. But number two, that 20 or 25-year amortization on the equipment loan can soften the blow of all these expenses happening with the equipment and the real estate. And it just might take a 20 or 25-year payment to make the overall transaction work.
Qualify.
Because if they're buying a building and they definitely need equipment to fill that larger space, to grow the business and keep everything on the upswing, if you're pegging that equipment on a 5, 7, or 10-year payment, it might not qualify. But now you have a 20 or 25-year 504 equipment loan, the payment is significantly lower, and now the whole transaction works. So it's what do they say? It's a beautiful thing.
It's a beautiful thing. Well, I appreciate that information. Just so
Yes.
the viewers can know you are able to do it. The economical life on that equipment has to be 25 years or more when the appraisal is done.
Yeah, we typically get something, a letter or a document from the manufacturer, and we can also refinance used equipment. So if it's used, we hire an equipment appraiser, and in their appraisal report of that equipment asset or assets will state what the remaining economic life is. So the equipment terms follow what the real estate terms are. 10-10, 20-20, 25-25. So it just depends on what they're buying, what their REL is, remaining economic life. But last year I did a $6 million equipment loan for a commercial laundry operation that washes clothes for hotels and restaurants for the workers. And he was growing and expanding, and he really appreciated that 20-year equipment loan payment.
It helped a lot.
Yes.
Now, and that's also the same structure where there's a conventional first and the SBA sits second on the equipment.
Correct. Every 504 will have a first mortgage lender. There's a few non-bank lenders out there, but every 504 structure will have a first mortgage lender and then us as the second mortgage lender. So same structure, basically. Yeah.
Got it. Well, Lee, thank you for all the amazing information. I hope the viewers were able to learn. And if any of you have questions, you can always get a hold of myself or Lee at BFC to learn further. Thank you, Lee. And it was always a pleasure to have you on the show.
Very happy to be here. Thank you for the time and look forward to closing more transactions and
Absolutely.
helping more small businesses together.
Definitely.
Thank you, Kamiar.
Thank you for watching. If you enjoyed this episode, please give us a thumbs up, subscribe, share any questions or comments in the comments below, and follow us on social media. I look forward to seeing you next time.
Let's get together. Let's get to having some fun. Let's do whatever. The night's looking so young. Let's get together. Let's get to having some fun. Let's get together. Let's get together. Let's get together. Let's get together.